Welcome, it's Guy Freeman from My Wealth Solutions. We're here with a budget update. Now that the dust has settled, we thought it'd be a good idea to just go through some of the major changes. Just as a bit of a summary, again, it's disappointing from our point of view to see the government tinkering again with superannuation. Just leads more people to be less confident in the system. In saying that, there is a degree of fairness, but there are some major changes that are going to affect, some strategies that are actually in place now for people with their super and also going forward. So let's have a run through some of the major ones. So the first one being the introduction of the $1.6 million cap per individual. So what this actually means is that if your balance is above 1.6 million in superannuation and it's transferred into pension, you actually need to take that back into anything above the 1.6 back into superannuation phase, being taxed at 15%. So if you remember, pension phase, no tax, superannuation phase, 15% tax. This is also, going forward as well as any existing balances. Now, if you're part of a couple, that 1.6 million is each. So effectively, with some good planning, you can get that up to 3.2 million. The other strategies around that is to make sure that we're actually spending any money that's outside the super system to fund retirement and letting our tax-free entitlements grow inside super. Our next big change with is the high income earners. Just going back on to the cap, there is some strategies around this as well. So big one is the super splitting strategy, where you can share your concessional contributions with your spouse. Make sure that we are making our non-concessional contributions up to $500,000 into the spouse's account with the lower balance, so we can use both those $1.6 million caps. And we also want to make sure that if we're both working or there's a partner working with a lower super balance, that we are making as much in the way of contributions as possible leading up to retirement. High income earners, some changes there. So there's actually going to be a tax of 30% on concessional contributions if your combined income and super is greater than $250,000. Now, this used to be $300,000, so essentially, the threshold has been reduced by $50,000, and is one that's gonna hurt the higher income earners. Some strategies to consider here really are, maximising our non-reportable fringe benefits, including, utilising the otherwise deductible rule. So this is things like being able to claim our income protection, that's otherwise deductible, and then also some investment property costs. So there's still some really good planning around that we can achieve there. Next major update, lowering the tax deductible contribution to 25. So what we mean by tax deductible contribution, it's a combination of what your employer is putting in for you into super, so your SG guarantee, as well as any salary sacrifice. So anybody that's under the age of 50 has been reduced to 25,000. Anyone that's over the age of 50, it has been reduced to 30,000. So again, just some more ways that they are really increasing their revenues to beat the budget deficit. Next one is our $500,000 lifetime limit for non-concessional contributions. So what we're really talking about here when we say non-concessional is our post-tax contributions into super. So we now have a lifetime limit of 500,000, and and looking at especially for the small business owner, it retrospectively goes back until the 1st of July 2007. So This is a massive reduction in the amount that we can, contribute into our super. It has been previous that it's been $180,000 per annum for our non-concessional, so our after-tax contributions into super. And when I mean after-tax, say you have money in the bank account that you've saved up and you want to contribute it in, that's a non-concessional. And we also had the bring forward rule of 540,000, so bring forward 3 years. So that's all been abolished, and we now have a $500,000 lifetime limit. Major strategy to consider here is, look at utilising, there's some changes in the age that we can contribute up until now. So we'll just talk about a bit more of those in a few moments. Next one is the spouse offset. So there's some changes there. So for the low income spouses, the current tax offset super threshold will increase from 10,800 to 37,000. So essentially, it used to be if you were earning up to $10,800, you would be able to receive a tax benefit if you contributed on behalf of your spouse. It's now increased to $37,000. So this should open up, a lot more people being able to utilise this strategy, and the benefits up to $540 as a tax benefit. So, that's a good one all round for low income earning partners. Next one is for people under age 75 can now claim tax deductions for personal superannuation contributions. So another major benefit to try and equalise out accounts for people not earning income or who want to top up their super effectively, even if they are over the age of 65. So really with this one, the limit stays at 25,000, and it also removes the 10% rule for substantially self-employed. So essentially you had to prove that you had less than 10% of your income from employed sources, but that's now been abolished. So another, generally good change. So strategies consider here, offset any other taxable income for a longer period of time, because we can do it up until age 75 now, and making sure that we've utilised our, the amount that we can put into super, especially on that $500,000 non-concessional limit. Next major change that is another good one is the change in annuities. So essentially from July 2017, a tax exemption on earnings in the retirement phase for products such as annuities and group style products will now be tax exempt. So the real opportunity here is for people with balances of 1.6 million already in super, is to transfer anything above and beyond that, having a look at annuity to see if that's suitable, and it will now be tax exempt. Now, there's been some big proposed changes, I should say, to transition to retirement pensions. There's a lot of people with these things set up at the moment, and also, having a look at this strategy moving forward into retirement. So what the government is actually suggesting here is that the tax-exempt status of the earnings is actually removed. So at the moment, if you have money in a transition to retirement pension, there is nil tax on the earnings. So they're actually looking to remove that. So could be huge ramifications. So we still need to get some clarification around that one, but that looks like the way that they'll be moving forward. A quick one on the anti-detriment. So this is a fairly outdated and interesting provision that was introduced during the Keating years, and it's to do with tax on super funds, and it's now to be removed. So there was a benefit that you were able to claim back once a death benefit was paid, but now that has been abolished. So, you know, I guess this is the world we live in, and we need to just make the most of the changes. So, you know, if you're someone that's looking to maximise tax deductible contributions, really, really important now to start looking at those changes. Coming closer to retirement, that 500k lifetime limit, that's a huge change to the current 180 per year, or the 3-year bring forward 540. And if you have over 1.6 million in your account, you know, there's some definite strategies there that you should be having a chat to your financial advisor about. So as always, I hope you enjoyed this update, and if you have any questions, just click the contact us link below, or you can always give us a call for a chat.